Sticky inflation, an AI Capex boom, and record capital raising are colliding just as headline volatility drifts lower. This is vTalkInsight, Equity Pulse Daily for July 13th, 2026, where we unpack what that tension really means for equities. Let's start with the macro backdrop because the way central banks and bond markets respond is setting the stage for the next leg of equity leadership. The policy narrative has shifted from imminent rate cuts to an extended pause under persistent inflation pressure. Markets broadly expect the Federal Reserve to stay on hold and eventually guide policy back toward a neutral level near 3%, limiting the risk of dramatic further tightening. However, the Fed is openly worried that above-target inflation is proving stubborn, particularly in areas like technology, healthcare, and entertainment, which keeps the door open to renewed action if expectations start to slip. Bond markets are already doing some of the Fed's work. Inflation-adjusted two-year yields have climbed about 175 basis points from this year's lows, signaling a meaningful tightening in financial conditions even without new hikes. Yet policy is still not outright restrictive at the macro level, with nominal GDP running around 5.5% to 6% against a Fed funds rate near 3.6%, so monetary settings continue to support activity and, by extension, some ongoing inflation. On the ground, price pressure is being reinforced rather than fading. The Atlanta Fed's wage tracker has ticked back up to just over 4%. Unemployment claims are down more than 8% year-on-year, and survey data show elevated prices paid in both manufacturing and services. Layer on a powerful AI-driven Capex cycle that is pushing up input costs for chips, memory, storage, power, and even water, and the Fed is increasingly focused on the multi-year character of inflation rather than each monthly CPI surprise. Outside the U.S., Japan is emerging as a quiet but important swing factor for global liquidity. Policymakers are nudging pension funds and households to bring capital back home, which has driven a synchronized rally in Japanese assets, a stronger yen, and moves in government bonds. If Japanese institutions reduce their purchases of overseas bonds, especially in treasuries and parts of Europe and emerging markets, that could put upward pressure on global yields over time and subtly raise the equity risk premium. Against that backdrop, risk appetite in credit and capital markets still looks resilient. High-yield spreads are sitting near historically tight levels around 260 basis points. Investment-grade spreads are unusually compressed, and bond market volatility remains subdued. At the same time, net new investment-grade supply could approach $1 trillion this year, and equity issuance is robust, which suggests that later in the year borrowers may need to pay up with wider spreads and higher coupons to keep the funding window fully open. Large U.S. banks are clear beneficiaries of this environment. Trading desks are expected to report one of their best quarters on record in equities, and overall stock trading revenue is on track to be the second strongest ever, helped by brisk activity and elevated single-name volatility. On the advisory side, U.S. capital markets are running hot, with record equity raises and merger volumes, and Goldman Sachs already hitting $1 trillion of deal value at the fastest pace in its history. Under the surface, though, the cost of capital for AI-heavy projects is starting to edge higher. Tech sector bonds have lagged in total returns despite heavy demand for yield, and recent AI-related deals from names like Amazon and SpaceX have seen softer follow-on performance than earlier in the cycle. Oracle stands out as a pressure point, with its rating cut to just above junk and concerns that sustained cash burn on AI infrastructure could push it fully into high yield, highlighting how aggressive Capex plans are beginning to stress some balance sheets. Global risk-taking is also visible in currencies and market structure. G10 foreign exchange carry trades have delivered roughly 8% returns so far this year, outpacing global bonds and gold, supported by high policy rates and low currency volatility. At the same time, leveraged and single-stock exchange-traded products are amplifying both upside and downside in popular names, with trading volumes in some of these vehicles now rivaling the underlying shares and regulators signaling that closer scrutiny may be coming. The equity story increasingly runs through AI and semiconductors. Sector earnings grew more than 100% last quarter, and analysts expect similarly strong numbers again, making chips a central pillar of current index-level profit growth. But valuations and technicals tell a more fragile story, with some semiconductor benchmarks up close to 100% year-to-date, pronounced day-to-day moves of 2 to 4%, and downside scenarios pointing to potential corrections of 20 to 25% from recent peaks. SK hynix has become the poster child for this AI memory supercycle. It dominates high-bandwidth memory with close to 60% market share, counts NVIDIA as its largest customer, and just completed a $26.5 billion U.S. share sale, the biggest ever by a foreign issuer. The listing was 7 times oversubscribed, the stock jumped well into double digits on debut, and banks estimate as much as $14 billion of passive inflows as it joins major indices, underscoring intense demand for pure-play AI memory exposure. On the fundamentals, memory producers are enjoying a rare combination of strong demand and constrained supply. SK hynix and peers have aggressive expansion plans, and Micron is lifting its U.S. investment commitment toward $250 billion, but most of that new capacity will not hit the market until late 2027 or beyond. Executives at SK hynix even warned that shortages in advanced memory could persist into the next decade, suggesting pricing power may stay elevated for several years if AI infrastructure spending continues on its current trajectory. The risk side of the ledger is equally clear. Earnings growth for AI-related semiconductors is heavily concentrated in a handful of large data center operators, so any hint of Capex slowdown in commentary or guidance could ripple quickly through leading chip names. At the same time, hyperscalers are investing in proprietary, lower-cost accelerator chips, and Chinese AI providers plus open-source models are increasing competitive pressure, which could compress margins and challenge current assumptions about long-term data center growth. Beyond chips, the AI build-out is straining real-world infrastructure. Data center demand has ended a decade of flat U.S. electricity use. Grid connection queues are forcing operators to consider on-site power solutions, and rising regional power prices are feeding political and community pushback. With roughly $100 billion in AI-related listings and about $200 billion in associated bond issuance already this cycle, some observers now see classic bubble hallmarks, and there are early signs of AI fatigue as credit investors grow more selective about adding new exposure. Headline indices still look calm. The S&P 500 has chalked up gains in 13 of the past 15 weeks. Volatility is back near the mid-teens, and last week's move higher came on relatively light volumes. But that stability hides narrow leadership and very demanding expectations, with a small group of large companies carrying most of the earnings burden and consensus looking for profit growth of around 22% year-on-year, the most ambitious since the post-pandemic rebound. Regionally, leadership is becoming more nuanced. European equities are showing broader earnings strength, particularly in AI-linked sectors, but also in non-AI compounders, and around 60% of their profits come from areas like banking that tend to benefit from moderate inflation. Japan is attracting attention as pension fund repatriation supports domestic assets, while in China, renewed investment in data centers, efforts to build a local semiconductor stack, fiscal support, and tentative property stabilization are all helping as shares narrow the performance gap versus global peers. In cyclicals, energy and travel continue to send interesting signals. Physical oil markets look tighter than futures pricing implies, with diesel crack spreads jumping on refinery disruptions and China relaxing refined product export quotas in ways that could lift crude demand and strain inventories. Despite higher fuel costs, Delta Airlines just delivered quarterly earnings that beat on both revenue and profit, reaffirmed full-year guidance above consensus, and highlighted resilient premium demand plus the benefits of its refinery hedge and growing ancillary businesses. Stock-specific stories also reflect this mix of resilience and strain. EasyJet is at the center of a bidding battle, with Apollo's higher, friendly offer sending the shares sharply higher and underscoring renewed private equity interest in European aviation assets as the industry recovers. Volkswagen, by contrast, is planning to have its model lineup and potentially close plants amid intensifying competition from Chinese automakers. But internal resistance to job cuts is complicating restructuring, highlighting the structural challenges facing legacy automakers in Europe. Among U.S. large caps, Meta Platforms is working to convince the market that its heavy AI spending can pay off. Management is rolling out tools such as low-cost API access for its Muse Spark model, exploring monetization of spare compute, and building consumer and enterprise AI businesses, all while its valuation sits near the low end of the range since late 2022. Apple, meanwhile, faces tougher competition in China, where sales fell during a key shopping period as Huawei gained share, but global iPhone volumes are still growing modestly, showing how even marquee brands are navigating an environment of shifting regional demand rather than simple uniform growth. Putting it all together, equities are trading in a delicate balance. Policy rates are on hold, but real yields have moved higher, inflation remains sticky, and Japan's capital repatriation adds another source of potential upward pressure on global funding costs. At the same time, credit and equity markets are wide open. Banks look set for strong trading and deal revenues, and the AI and semiconductor complex continues to deliver outsized earnings, even as valuations, infrastructure bottlenecks, and early signs of credit fatigue fuel a growing bubble debate. Market leadership is narrow, sector and regional rotations are accelerating, and single-stock volatility is being amplified by leverage, new trading products, and shifting retail behavior, all while index-level volatility stays muted. From here, the key signals to watch are upcoming inflation prints and central bank communication, guidance and Capex commentary from major AI spenders, and how credit spreads and issuance terms evolve across both tech and more traditional sectors. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.